Hi, everyone, and welcome to our third quarterly briefing of the Grocery Sentiment Index for 2025. In a grocery landscape marked by economic uncertainty, geopolitical tension, and shifting consumer sentiment, the retailers and CPG brands that win are those that predict what shoppers will do next. Symphony AI's Grocery Sentiment Index does exactly that, turning billions of data points into clear, actionable insights through AI that delivers measurable outcomes at scale. Last quarter's Grocery Sentiment Index, we saw an upward trend in shopper sentiment globally. Will that hold up through the second half of the year? What are the factors driving shifts in behavior? What can grocers and CPGs do to stay ahead of the curve? To answer those questions and more, please welcome Letitia Berthier and Josh McCann, who will be delivering our Q3 GSI report. This will be a 20-minute presentation with some follow-up questions at the end and a hard stop at 30 minutes. So let's dive straight in. Letitia and Josh, I hand it over to you.
Thanks, Steve, and hi, everyone. First of all, let me pose a quick thought. What if what shoppers say doesn't fully reflect what they actually do? Currently, and since the start of the year with geopolitical tensions, inflation, market swings, you hear a lot of negative noise, and it looks like shopper sentiment is dropping. But when we dig into real and actual shopper behavior, purchases, not just opinions, the story is sometimes very, very different. So that's the power of real behavioral data with millions of transactions coming in every single day. We don't need to guess, we know. So the key takeaway for today, in a noisy world, data-driven insights are your best compass. At Symphony AI, we analyze data from millions of households globally and billions of transactions every day, powered by AI. For this study and to build our grocery sentiment index, we analyzed data from 64 million households, over 600 million transactions, and 6 billion units sold from our grocery retail clients across the US, Europe, and Asia. We analyzed slightly more than 3 years of data from 2022 through the end of September 2025. This allows us to provide both a long-term perspective, but also to incorporate recent data. So now, what is our grocery sentiment index? For people who haven't joined us in the previous quarters, think of it like a pulse check on how people are shopping today, but with a predictive twist. To build it, we put the customer at the center. We analyze real purchase behavior using loyalty card data to understand how people are truly shopping. It gives us a very clear view of what's happening now, and it's also forward-looking. We're using our proprietary AI models to spot emerging trends early, to understand top sales drivers, and to predict the trajectory for the next quarter. The index, as you can see here, runs on a simple 0 to 100 scale, broken down into 5 sentiment levels, from very poor to very good. On the left, you've got unhappy shoppers who are pulling back, cutting spend, or switching brands. In the middle, it's steady but cautious. And as you move to the right, you see more optimism, shoppers buying more, engaging more, showing stronger loyalty. So it's a quick and very, let's say, visual way to grasp how shoppers feel today and where their behavior is heading tomorrow. So now I'll pass it over to Josh, who will take us through the global findings for Q3.
All right, thanks, Letitia. Yeah, well, now that everybody's got a good sense of either a reminder of what the GSI is and how it works, or maybe your first time, let's dive in, and we'll start at a global level, and then we'll take some time to go through each of the 2 regions, looking at the US and Europe and Asia separately. So let's go ahead and dig on in. So first thing that you might have either noticed or remember is at the end of 2024, we found ourselves kind of at the bottom end of, the bottom end of a decline in the GSI. And when we first started reporting, which was the first quarter of this year, we actually showed a rebound, right, going from 41 to 45. And if you look back on your on your history lesson, what was happening at that time? Well, there was a lot happening at that time. There was all of that instability led to by new U.S. administration, all of the tariffs that were affecting both the U.S. and abroad, some pretty sticky inflation, and a lot of cost concerns from the customer. Yet we saw the sentiment index in the grocery space actually show a positive trend. Now, the next 2 quarters, you fast forward, we see a bit of a slight increase, and then most recently here in Q3, a slight fallback from 49 to 47. So we're sitting kind of right in the middle of this neutral zone after a couple of quarters of just, you could probably say some more stability. But again, a lot going on in the consumer's mind that's driving this, and we want to start to now dig into what does that mean region by region. So if we look at here, the general trend, if you see, the 2 regions do track to one another somewhat closely, over the longer term, with some, divergence from that. But most recently, we see that the 2 regions have actually come very, very tight with one another, both coming from, from a slight decline. U.S. at 49 down to 47, and Europe and Asia from 48 to 47. We can argue for a while if that's flat or down, but regardless, right? We're seeing a very tight connection between the 2 regions, and this really hasn't happened since we look back in time to the end of 2022 and 2023. And what was going on at that period of time was actually massive inflation across the world, and we'd seen the Ukraine war was just kind of, I would say, hitting its stride, was really becoming prevalent, having started earlier in that year. But again, this tight alignment to the sentiment of the consumers in both regions begs some interesting questions. And what we want to now do is dive into the drivers of that sentiment, so you can see maybe how they're similar or not similar in the way that we're getting there. So I'm going to hand back over to Letitia so that she can walk through how and what we're seeing in Europe and Asia.
Yeah, thanks, Josh. So the shopper sentiment in Europe and Asia is stable in Q3 versus Q2. It's still in this neutral zone, not that positive, but not that negative either. What we have seen is 2 strong positive effects, stronger traffic and higher frequency of visits. But these positive effects have been offset by a decline in loyalty, exactly as our AI models predicted last quarter. So it's something that we were expecting, but unfortunately it has happened. Decline in loyalty means also shoppers are spreading their spend across more banners. That's clearly a big trend here in Europe and Asia at the moment. And not all categories are impacted the same or driving the sentiment the same way. We have some everyday essentials still driving growth, like bakery, meat and poultry, coffee and tea. Others that are dragging the performance down, alcohol, ice cream, up to beverages. So, and I remind you, by the way, when I talk about ice cream or beverages, it's all corrected for seasonality, okay? Everything we are showing here is corrected for seasonality. So in that case, even when we have a stable sentiment, the dynamics beneath are shifting very fast. And also what's coming can be very different. So now what's coming in Q4, let's take a look. The outlook for Q4, unfortunately, is not much better. We are forecasting a slight decline across Europe and Asia. Traffic will start to soften, and the loyalty drop that we saw in Q3 is predicted to continue into Q4. So in short, the engagements remain quite fragile. We're not going into the poor range, but for sure is that retailers will need to work much harder to retain their loyal shoppers and to capture those switching behaviors very early to avoid impacting too much the performance. So we are seeing, and if we want to summarize what's happening in Europe and Asia, the shopper sentiment index remains stable in the neutral zone in Q3. We're forecasting a slight decline as we move into Q4. The drop that we've seen in loyal customers so far has been balanced by a stronger store traffic, but both indicators now are expected to soften in the next quarter. And if we look by category, the everyday essentials continue to sustain a positive sentiment and should be preserved, but categories like alcohol or fruit and veg and beverages are a bit underperforming and will need some focus. So going forward, and our recommendations priority is about loyalty retention. That means we must identify at-risk loyal shoppers early, re-engaging them through personalized offers, reinforcing the reasons to stay, whether it's price perception, convenience, or unique value. And of course, AI can help detect these early signals, guide your actions, and to avoid impacting your performance too much in the future. And when we look at the categories that we see declining, here key recommendations, of course, use targeted promotions, communicate better value, especially for the categories that are key at Christmas, for the ones we saw, alcohol, beverages, clearly. So in the next few months, it's about protecting your base, using data intelligence to turn this, let's say, stable sentiments into sustained loyalty. Now back to Josh to focus on the US.
Okay, so again, the reminder here in the US, we saw sentiment decline slightly from 49 down to 47. Again, from earlier quarter, another decline. So a little bit of a slide. We had predicted to see a bit of an improvement in the last quarter, and what we found was that there is a higher than anticipated increase in average price that really contributed to that. And then there was what appears to be a knock-on effect to units. So those two things were really the drivers that kind of held back or pulled down the sentiment in the US in this quarter. There was some offset, some positives to that. We saw some improvements in loyal customers and a bit of an improvement in traffic. So while these offsetting things didn't reach a positive number, still not really a massive change from quarter to quarter. So from a category standpoint, a couple interesting things. We saw two categories that were seeing positive effects were a driver last quarter, and now we're showing as draggers, and those are snacks and cooking ingredients. So two categories that have unfortunately moved backwards in the consumer's mind. But when I took a step back and tried to look across the suite of categories and looked at some of the ways that they're moving as a group, it signals to me the potential that consumers are leaning into fresh and almost like immediate needs. These meat, poultry, ready to eat. You can read a bit about just this food away from home continues to be impacted at a higher rate than maybe food food in the home that groceries focused on. So I think consumers are starting to vote and saying, I need to replace some of those food away from home meals with something at home, and they're seeing fresh products and ready to eat products as ways to do that in a simple manner. And then on the other side of that, there's a lot of categories that tend to have longer supply chain cycles, even longer code cycles. And I think these categories are seeing kind of the longer term impacts of tariffs that maybe are finally hitting these categories. So while canned products tend to be value driven, that's the value perception of those, if they're just now seeing increased prices and increased costs, they give the perception of being more expensive when compared to items that are fresh in nature, despite the fact that they're not. So I think those two things together are giving the consumer an interesting quandary and for how to meet their needs. And right now they seem to be leaning towards some of these fresh categories while they're impacted by the ongoing impact of tariffs over time. If we talk about what's going to come our way, hopefully, again, the good news, I think, is that, and we think, and what we've predicted is that the sentiment will improve a bit. So I look back to what happened in the first quarter of this year as we were going through all of that, initial political issues with tariffs and things that I talked about before, and yet consumers turned to the grocery industry to help provide some comfort and offset some of that other lack of, or that other discomfort. And I think as people and we're moving into the fourth quarter of this year, while we've not seen inflation increase significantly, I think the impact of that becomes more top of mind for the consumer, right? We're coming into Thanksgiving and Christmas, and there's a lot of pressure. So I think that in a good way, the consumer is going to turn to the grocery industry, turn to us to help to meet their needs. So we're predicting that we're going to see an improvement in volume, in units per customer. We're going to see a continuation of that loyal customer strength and even some of that traffic. So we're a bit bullish in the U.S. as what we think can come from a sentiment standpoint and how we can use that to our advantage to grow our mutual business. So I'll summarize quickly again. The sentiment index was flat to slightly down, but we're predicting a nice, hopefully, recovery, maybe into the good range. I don't know. That's we see some good signs. Although the traffic increase we saw in the third quarter, that was offset by that higher than anticipated price increases and the knock-on effect of units. And then we see customers appearing to be pulling back on some of these longer supply chain cycle categories that are, in many cases, they're staples, they're stalwarts of your pantry, but customers are maybe now just feeling and noticing what has been coming their way for quite some time. So what can you do about it? Not an exhaustive list by any means, but first I think is consider the mix. So look at the mix of support that you have for fresh versus other types of products in your ad and circular planning, right? Make sure that you're taking advantage of the customer's needs to meet some additional meals at home because they maybe aren't going to have meals away from home because of those cost implications, and pulling back to be ready for the holidays. Next, monitor loyal customer conversion. I talked about that. Loyal customers are growing here in the US. And if we see categories like maybe canned vegetables or instant consumables, those things that have that longer purchase cycle, you might need to react. If you see an issue with conversion, right? Basket penetration with that customer, household penetration with that customer, you might want to or need to take action to avoid losses in these very important categories. And again, AI can help you to detect those very, very quickly and simply. And last, I mentioned increase in units per household. So maybe it's time to think about that good old one more item in the basket tactics, right? That if customers are willing to buy a bit more, let's think about those kind of tactics and put them into play. Multiple pricing, make sure that you have a 2-for or 3-for available on some of those expandable consumption items and categories. Think about product affinities. AI is a great way to understand what items or categories are in the basket together and give those customers the suggestion through your circular or even through your merchandising tactics to help to get that customer to put that one more item in the basket to grow your sales. And then from a digital standpoint, we always have the opportunity for product suggestions, marketing, media. Think about this again with those very complementary items that can help the customer to meet their needs and you to grow your sales. So let's go ahead and wrap up here and kind of come back to the beginning of saying what customers say and how they tell us they're feeling does not necessarily always match their actions, especially in our industry. And understanding that and being able and willing to act upon it can be a competitive advantage for you. So we hope today you've got some nuggets, some learnings that will help you to make a very successful Q4. And we look forward to seeing what Q4 has to hold and what's coming in Q1 in our next release that will be coming to you in January. So I'll wrap up here and hand it back to Steve and see if we got maybe a quick question or two before we have to wrap.
Yeah, thanks, Josh. Thanks, Letitia. We do have some questions. First, I'm curious, do you have a hypothesis as to why the two regions are trending so close to one another over the past few quarters?
I'll take a stab real quick. I think there's not been, from what I've seen, like any massive new events or things that have caused dissonance between the two, right? For them to go different directions. Now, that said, I do think that, and we showed that they're getting there in different ways, right? While the ending sentiment might be the same, the drivers of those things were different, right? We saw from a driver metric standpoint, Europe was and Asia were seeing an improvement in trips, and so was the US. So those were the same, but loyal customers were actually trending in the different direction. Price was actually trending in different directions, and units in many cases. So the way that they're getting there is different, and it reminds me of we recently released our annual e-commerce study, and both regions were actually showing great growth in e-commerce from a channel standpoint. Again, but how they got there was quite different. The US was growing in penetration of existing customers, where Europe was just growing customers. So I think it's, I don't want to call it coincidence, but the point is the customer's feeling similarly, but the feelings behind the feelings are a bit different, if you will.
Yeah. How do you suppose that translates from a category standpoint?
Yeah, maybe I can take this one. Yeah, you saw that there were some categories that were quite common or that were quite strong both sides, like fresh categories. We saw fresh meat and poultry, for instance, were really performing well in both regions. But a lot of others are not going in the same direction. So that's where you really have to de-average and look behind and look at what are those different drivers and what should you do. So yeah, clearly it's not all common, not always all going in the same direction, and that's why also and even within a region, two retailers may have a very different story and very different trends. So it's the power of data. You really have a lot of information in your hands. Just take the time, have the right tools to analyze that data and take the right decisions. So yeah, it's all about de-averaging, I like to say.
Agreed.
All right. Well, that's all the time we have for questions today. If we missed any that went through the Q&A, we will get back to you individually and follow up. Also, I wanted to remind everybody that after the conclusion of this, you will have access to the recording as well as the slide presentation. So we're going to wrap up now, and I want to thank Josh and Letitia, and especially everybody here who has joined us. We're looking forward to seeing the Q4/year-end results, which will be released early in 2026. And until then, stay in touch, and thank you for joining us. Have a good day.
Okay.
Thank you. Bye.